Welcome back. I'm Pierre Daly, and this is Insight is Capital. Investors who wait too long to get off the sidelines may find they've missed out. Bonds could see a big boost as central banks pivot toward rate cuts in 2024. Yet almost $6 trillion is still sitting in money market funds, a vestige of the T-bill and chill strategy made popular in 2022 when central banks were aggressively hiking interest rates. But we've turned the corner now, and it's time for investors to consider getting back into action. Today, we're going to be talking about how you can approach the practice issues of repositioning cash for the long term, what's ahead for investors in this new era of higher for longer, and the major wealth succession challenges that could precipitate a key business risk advisors are facing as assets transition from boomers to their heirs. My special guest this episode is Mario Cianfrani. Mario is head of distribution for Vanguard Canada. Most recently, Mario was head of national accounts and institutional sales and was previously head of ETF capital markets. Before joining Vanguard in June 2015, he was a portfolio manager at First Asset Investment Management, responsible for domestic and global equity ETFs and sector-based North American covered call ETFs. Mario has held several senior sales and trading positions with a number of Canadian capital markets teams. His experience includes trading equity derivatives and market derivative-related risk management solutions to a broad range of clients. Mario earned a BA in Applied Mathematics from New York University and is a CFA charter holder.
This is the Insight is Capital podcast.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of AdvisorAnalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Mario, welcome. It's an honor and a privilege to get this chance to chat with you.
No, the honor's mine. I appreciate you taking the time. I'm looking forward to a really good conversation and a dialogue, and really appreciate the time again.
Likewise, Mario. I've been looking forward to this conversation. So one of the big burning questions right now is how to take money off the sidelines and put it to work. How do you see the shift from defensive to opportunistic investing posture impacting the advice that you give to advisors for 2024, especially considering the comeback of 60-40 portfolios and bonds?
I would say the bulk of our conversations over certainly over the last year and into this year has been that defensive posture. You touched a little bit of that in terms of where money is going into cash and T-bills, and so the market itself has been very defensive, and I think investors have been very defensive. We've seen the flows into cash equivalent ETFs, and that was a large part of last year's flow, a large part of where fixed income flows went, and so the market itself, whether it was individual investors and to a certain extent advisors, had taken you mentioned defensive posture. They'd taken a defensive posture with either existing money that was already at work or with new money that was coming in, and just the storm that we'd seen through 2023 with rates rising as aggressively as they had, and the impending recession that unfortunately or fortunately hasn't come, led to a lot of that money being put on the sidelines and waiting to be deployed. I love the saying, never let a good crisis go to waste. And, I think, through that, it's interesting because as I look at returns in the equity markets, TSX 60, just under 12%, the S&P did exceptionally well. I think just under 25% for the year. It is that defensive posture, and where an advisor plays a big role is through that, that behavioral coaching, staying invested, not just staying invested, but also staying with the plan. Oftentimes the plans are constructed well before we hit, choppy waters or, events that are outside of our control. But it's really the advisor's ability to sit down with a client and an investor and say, look, this is the plan that we came up with. The plan is working, and helping those investors really navigate times like 2023.
Yeah.
currently 2024. And so for us, we sit down with advisors and really reinforce the fact that they have an incredible opportunity now to be opportunistic, because there is a lot of money on the sidelines, and just making sure that not only are investors invested, but they're invested in their plan. And so if they have a qualified advisor who sat down with them and looked at their life goals from a financial perspective, just making sure that that plan is still working. It's still working in this under these conditions, and we shouldn't necessarily just react to what is currently happening in the market. And,
Right.
and so a lot of what we do is, helping advisors and supporting advisors in that message, but also through conversations like this, articulating that value of advice. And that's something that we've done quite a bit in terms of the perception and value of advice. It's really just helping investors understand that there is, a really important part that an advisor plays, not just from the portfolio management perspective, but that holistic advice. So that's we've spent a lot of time through the last couple of years and doing a lot of that and that messaging across dealerships in Canada.
First of all, sticking with the plan is probably the best thing to have done, and withstanding obviously the pullback in the duration side of the bond market. And then it was pretty obvious that given last year's uncertainty, and I think the misstep of last year would have been to have been out of the market and miss out on although the market was driven by seven stocks, to miss out on the S&P 500 at the very least would have been a significant misstep. And then going into the end of 23 with the very end of 23 with the pivot from the Fed, but the anticipation of that pivot, that was a very tricky time as well. If you consider, what happened to the term premium, what happened with long duration bonds at the very worst, the dusk, the dark before,
of course, yeah,
the quiet before, right? Like that period in October, November was very, was very dark. And then at the same time, it's very frustrating. So you can see where investors and advisors could easily be tricked out of the market, out of staying the course. And so, you being there to provide the guidance as well, guidance to advisors, and then have that trickle back to investors is critical. And of course, portfolio construction, that addresses the known unknowns, the uncertainties, in advance of the events occurring. I think that's a very important factor in portfolio construction, being able to stay the course and being able to explain to a client, to an investor, this is why you have these diversifiers. This is why you have some of these items in your portfolio that you don't necessarily like at certain times, because you wonder, you're scratching your head, why do we own these things? And then now is why we own these things, right?
Absolutely, Pierre. I mean, you're touching on a lot of themes there in terms of what we're doing and helping advisors tell that story to their investors. Providing clients with that education, but also supporting the advisors with that message. You talked a lot of things through that. November, December were really tough, and nobody really, we need bonds, and sometimes we don't like bonds, and when they underperform, it's just another reason why, hey, maybe I shouldn't have this part of my portfolio. But again, when we meet with advisors and providing them with historical context, and context not just within from a Canadian perspective, although that is a big part of what we're doing, we're also bringing the rest of the world and the global context into those conversations. It's really, really critical, because you could make that knee-jerk reaction when you take those 1, 2, or 3 months out of the sample size, and suddenly we're in a period like 2024 where the probability of higher returns on bonds are there. The calls for the death of 60-40 might have been a little bit premature, and the 40 part, the bond portion, the fixed income portion, looking to return, looking to be a meaningful contributor to the overall portfolio. Now, 60/40 might not necessarily be what every client needs, but, within a balanced asset allocation across not just fixed income and equities, but also spread across geographies, having that diversification where you're not tied to any one market. That's really, really critical for us when we are sitting down with advisors and helping clients just understand that the benefits of diversification and the benefits of having the plan, right? We talked about sticking with the plan, but also having the plan heading into these moments where, again, you look back in hindsight, it's easy to look back and say, well, the S&P is up 24%. I should have been all equities, but, now we're in a period or not been in cash where a lot of that money moved where, there were periods through 2023 that were risk off, and the money didn't go necessarily into bonds. It didn't go short or long or long duration. It went right into cash, which for some investors that may be appropriate, but for the vast majority, sticking to that asset allocation plan would have returned, would have provided high returns. So for us, it is that education. It is providing those services to advisors to be able to stress test portfolios through periods like, the end of 2023 and certainly where we are today.
Yeah, definitely. I recall a conversation. It keeps coming up in various conversations that I've had with some of our other guests, but one of the most striking conversations that I recall from the late summer, early fall was Ken Griffin on Bloomberg, and he was asked, what was the most surprising thing that he saw in the market right now, and his response was the most surprising thing, which was that he just turned around. He turned around and he said, you know what, 60/40 is really interesting right now. 60/40 is attractive right now. And all he did was actually flip the script, because at the moment that he was asked was, this frustrating moment of, what do I do with my portfolio? I hate this 60/40. Right. And yet all he did was he turned the chart upside down, so to speak, and say, well, look at the, like stocks are cheaper. Bonds are cheaper. You couldn't find, if you were entering the market for the first time, this would be a really good time to take on a 60/40 portfolio. And I thought that was extremely, prescient and wise. And so given the challenges, given the volatility of 2022, what strategies are you recommending to advisors to bolster investor confidence in the current higher interest rate environment?
Yeah, a great question. I think there's a lot of things happening within the space, a lot of exciting initiatives, certainly from us. What we're trying to do is, again, it goes back to that education and helping advisors tell that story, right? As I look across our office, there are crew members, as we call them, who have never seen interest rates rise. And so, I jokingly walked through the office and said, hey, everyone, interest rates also go up as, they don't always go down, right? And so a lot of that, it's providing that context to investors, to advisors. We are in a new era. We're in an era that many investors haven't participated. Many financial professionals have never seen rates rise as quickly as they have. And so for us, it's really, again, we go back to that historical perspective, looking across history. It doesn't repeat, but it sure rhymes. Right. And taking those periods and saying, hey, this looks like another period, and here's what happened. And, again, we're thinking in terms of probabilities. It's not going to be exactly the same, but it's certainly, there's a lot of cyclicality to the markets and to different periods of either interest rates going up or down across the markets, and we can look at those as benchmarks for what we think may happen here with a decent degree of probability. So for us, it's using those historical precedents through what we call portfolio consulting. We help advisors and we take their portfolios. We run it through an internal model. And again, we're looking to help them do their job better. And so from a portfolio management perspective, we'll engage with an advisor who will give us one of their models and say, hey, look, is the model doing what I think it's supposed to be doing? One. and what will the model do under certain conditions. And so we like we like to take those are the really, we like those engagements. Those are the engagements where we feel that we're really partnering with advisors and dealerships across Canada to really help them do their job better. And that's an engagement that's fun for us because we get to sit down and act, like a consultant with them. And that, that engagement, certainly we've had a lot of take up for that. We've done a lot of engagements with advisors. And so that's one area where I think we add a lot of value, and it's really nice for us to move up the value curve and not just be talking about product or be talking about positioning, but we're really looking at the plan. And so we're helping them stress test the plan, and then they can go back and we provide them with materials that help them talk to their clients to say, yes, this is exactly what we thought we were doing when we set out to put the plan together. So it's an exciting initiative for us, and we do that. Again, we have perspectives from our Canadian business, but what's also interesting is we can take perspectives across the globe. And so we consume portfolios from advisors from within the US, Europe, Australia. And so what's interesting for us is when we take and aggregate those data points and those portfolios, again, we can see trends and see where, Canadians are not that dissimilar from other parts of the world. And so running that and having that information and having that kind of data where we can look and see trends that are happening in other parts of the world and apply them here to what we're doing is also really, really exciting for us. So that global perspective with local market knowledge really adds a lot of value to what advisors are doing for their clients. And ultimately, the beneficiaries of all that is the end client. And so if the end client is getting a portfolio that works for them and helps them meet their financial goals with an advisor that they trust, who's helping them and walking them through that plan, it ends up being a win-win scenario for us, for the client, and for the advisor.
That's extremely high value. I mean, when you consider that any advisor who's placing assets with you can come to you and muster all of the resources of Vanguard to get guidance for their clients, and then be able to pass that information back to their clients. I can see it's easy to see where that would bolster investor confidence. Given the the very highly informed feedback that you're able to give, and the stress testing and making those tools. Like putting yourself at the disposal of clients, of advisors and their clients, to be able to do that. I think, it's something I would also add that because we had this zero interest rate environment, fundamentals sort of went out the window for quite a time. I mean, it's not that they didn't matter. It's just that they didn't add any value at the time. But now the thing that's changing, and as we get into this discussion about this new investing era, the thing that's changed is the reintroduction of interest rates, right? The reintroduction of interest rates forces you to have to go back to...
They matter, right? Yeah, they matter now.
Yeah, and so do fundamentals as a result. It's
right.
That's the trigger, right? When there was no interest, when there was no interest rates, when interest rates were, when money was free and companies and investors large investors could get capital for nothing, including in the corporate bond market. I mean, issuance was record levels for a decade. I mean, there was nothing to worry about. But now that interest rates are back, there's a cost of capital.
Absolutely.
Yes, there's a valuation model based on discounted cash flows. All those things have come back. And now, I think there's an entire cohort of advisors who have no idea what any of that really, the significance of any of that. And they know what it means from their schooling, from their education, but they haven't had the experience of seeing exactly what happens when a new discounted cash flow model gets introduced back to the market.
You're bringing back, for me, it was first year CFA, and for some it's first year 101. You're getting to apply some of those formulas that you learned way back when. So you're absolutely right. Like, the fundamentals matter. And, that's one of the awesome things about being at Vanguard, having, I often talk about having the $7 trillion asset manager and all the resources that are behind it. It's sometimes an awesome number. Trillions is, just the number itself is, it sounds almost sounds ridiculous, but I mean,
It does.
it's an incredibly large number, but what it does is, those resources and that perspective. And so what you're talking about is, hey, we have those resources that we can help bring to bear with advisors to help them. Again, we're helping them tell the story so that they can build a better practice, build better returns, better outcomes for their end investors. And ultimately, again, we're looking to help them support their business. But you're right, it's a lot of those things that we maybe didn't necessarily need to touch on when we're in a raging bull market and rates are near zero. But now rates do matter, and some version of 60-40, 50-50, 70-30 do matter. And so maybe that asset allocation mix may need to change in this new interest rate environment, this new inflation environment. And so those are all the things that I think we try to bring to bear in our conversations with advisors, and through the materials that we're, hopefully helping them with through their end clients.
Yeah, I mean, I'm guessing that if I put my advisor hat on, trying to help investors trying to help make sense of what's been happening the last year, even making sense of the Magnificent Seven.
Yeah.
I mean, that's a tough nut to crack.
Yeah.
I mean, because the gap in knowledge between the advisor and the end client can sometimes be quite wide, quite large, and having them understand a lot of the intricacies of valuation or the opposite. My question is really, given that the novelty of current high interest rate environment that we're in, for many investors, how can advisors effectively educate their clients to navigate that landscape? I mean, where would you begin?
It's a challenging one, and a great question. But I think this is where we come back to the value of advice, right? Should advisors be should they be stock pickers? Certainly, there might be places where tailoring portfolios to specific client outcomes and using individual securities that makes sense. Certainly within their models, but should they be trading? You mentioned Ken Griffin. Those are the people you're trading against, right? Yeah. Those are uber sophisticated firms that devote billions of dollars of resources to trading. And so the underlying message is, what's an investor's edge? And the investor's edge always has been time, right? And so the longer you extend time, and the longer you extend time in market, you're certainly not playing with Ken Griffin on his turf.
No.
And which you don't necessarily want to do, given the sophistication. But advisors have value outside of just picking stocks. It is that behavioral side that we sit down with, and Vanguard's done a lot of work around Advisors Alpha, which we came out with in the early 2000s, and just trying to put a number in terms of quantifying what we think the value of advice is from an advisor. And we came up with a number that's around 3%. Obviously, not a point in time, but it's helping them tell that value. It's not just about the portfolio; it's about that holistic wealth management plan and that financial advice that I'm going to extend, not just on the financial side, but your tax planning, estate planning, wills, accounting, all that is really part of the advice that that advisors can extend to their clients to move up the value curve, and not just deal with the product and the portfolios. So that's one area where we spend again a lot of time with advisors on Advisors Alpha. We've recently done a survey that flipped that a little bit and said, hey, investors, and we did this in the US and went to about 1,500 investors and asked them, what do you think the value of your advisor is? And so the interesting outcome of that is that the average investor thinks that advice is worth about 5%. And isn't that interesting? Where
interesting.
We're coming out and saying, hey, we think through all these these initiatives and technological advancements and what the advisor can do, we think it's about 3%. Individual investors think that the value of advice is even higher. And again, they talk a lot about behavioral coaching, creating plans, and that's what they value their advisors to help them with. And so it's helping them tell that story to individual investors. And so, that's another, interesting part of what we do. It's we have, again, access to, a wealth of data from across the world, and it's bringing that to bear to the Canadian market and with end investors. The third part that we spend a lot of time with on the practice management side is, I think you touched on it a little bit. What does the new environment do to that family plan or to the plan? And what we're seeing and sort of bubbling up to the surface is, in this high interest rate environment, high inflation environment, you have the next generation saying to mom and dad, "Hey, mom and dad, maybe can we maybe talk about expediting that inheritance," right? And so, again, we found in dealing with high net worth and ultra high net worth families and investors that the advisor plays a critical role in those conversations, to be able to have that, to be at the table and to be able to walk through that plan. And so we've created a practice management program called Family Legacy Planning, or Generational Wealth Planning, that, again, we're helping their practical tools that we help advisors use to have that conversation, because it can be a little uncomfortable to have that conversation. And so
Right.
this current macro environment is creating conditions where, it might be bringing up that generational wealth transfer that we've heard a lot about, from one generation to the next, to the second generation, or even to that third generation. So it's really, for us, it's practice management is a big focus for us. We want to partner with advisors. We want to help them through those conversations, but there's value to the end investor. There's value to the advisor's practice, because building out multi-generational accounts that aren't dependent on one individual lead investor. It's,
Right.
the family becomes the investor. And so that's another big focus for us. But again, and that's the educational part. And what's really interesting, as I look across the landscape, when we came out with Advisors Alpha, I think we were the only one that was having that conversation. And what's interesting, over time, we've seen a lot of similar pieces come out. And with family legacy planning, as we've started to have that conversation, we're starting to see that, that type of conversation be had a little bit more, and the volume of that conversation within the market is a little bit louder. And we think that's awesome. We think that's great for advisors, but obviously for investors, because the more that the market or the profession has that conversation, the better the outcomes for everyone. So, we're pretty excited about that particular piece of practice management.
Yeah, it's very interesting. Investors overvalue, relative to what your findings were with Advisor Alpha, which was that of 3%, investors are overvaluing the value of an advisor, at 5%. What do advisors think is the value of? Putting aside ego, do advisors undervalue their own value?
Yeah.
And are they underestimating the value of the components of Advisor Alpha in their own practice? Like, are they taking it seriously, is my question.
Yeah, that's the question. And I think being able to articulate that value. I'm not just a stock picker. I'm here to help you with your financial plan, and that financial plan is multifaceted. There's many components to it. The portfolio is just one of those components. And I think extending that conversation out beyond just the portfolio, beyond me just picking stocks for you or creating that model, that's, again, where the real value is. And that's where I think advisors can, not only justify their fees, which, again, we're paying for professional services, but also retain their fees, right? Because, again, they're articulating value. And I think what we found with end investors is they're willing to pay for value. And so to the extent that we can help advisors and educate investors that what is happening is that they are moving up that value curve. We talk about moving up the value curve and providing value added services that can save money, that can put you on a better trajectory for long-term financial plans, whether it's, sending your kids to university, helping them with their first house, or whatever the plan is, or retirement obviously is a big thing and a big theme here in Canada. So to answer your question, I think so. And I think as we speak to the heads of the dealerships across Canada, they get pretty excited about, some of the practice management programs we've talked about, Advisors Alpha, our value of advice, because it's, hey, help us tell, our advisors what the value of the services that we provide. And so, I think that's part of our job. That's part of what we try to do, and providing those value added services and the value added content, I think, is one step in that conversation. But I think so, and I think the industry is getting better. I think it's getting more professional. I think it's getting, the services are richer. I think there's a lot more data behind it, and so I think there's, you're starting to see the benefits of, that holistic plan and that holistic business, looking at, investors across multiple spectrums, and not just focusing on one side of the business. It's a cohesive, again, we keep coming back to, it's a cohesive, holistic plan for individual investors.
Yeah, and it's a nudging process, right? It's just ongoing nudge, nudge. Try this, try that. I'm curious, you mentioned the succession planning, and there's that key business risk for advisors, right? That their elder clients who are nearing retirement, in retirement, and more senior, are in the late third of their life, and of course then there's the heirs. So when the succession occurs, there's a significant risk that the advisor will be traded as well.
Correct.
And so, what does that look like when you are talking about succession planning? What is the vision, or what does it look like? How do you get the whole family into the fold as a unit so that there's that cohesion? What's the advice to advisors to say, okay, how do you get everybody in the room?
That's
right.
Look, that is the question, and it's a great question. I think the first step is to try to have the conversation, because I think we've had a generation of advisors who have dealt with the lead client, which is typically the husband. Yeah. But for us, it's to talk about some of the business benefits to them, for them, to engage with the rest of the family. And so, when we present some statistics, when you're talking to not just the lead spouse, you're talking to the spouse, to the family, to the kids. Generally, those practices have about 58% more assets than families who just deal with that lead, that lead investor. They generate, in general, in aggregate, about 60% more revenue. They have about 3 times more accounts. And what happens is, you're right. If you're just dealing with that lead investor, they are going to age, and they are going to start tapping into their RSP and then their RIF, and then drawing down in deaccumulation. But if you've engaged with the family, you now have the spouse, you now have the kids, and you may have even the next generation after that, the grandkids. And so what we're finding is, when we present some of that data, and again, I think part of the issue historically has been not having the data. And so, what an awesome time to live, where we can have an aggregate sources, across the Canadian landscape, and look at really big, broad trends, and present some of those findings to advisors, to say, look, this is the benefit, because that conversation is a little uncomfortable. If you're used to dealing with one person in the family saying, hey, I think there's a business benefit to being able to engage with the rest of the family, it is a little bit uncomfortable. We're trying to get them out of their comfort zone, but we have some initiatives and some tools and some games that can help them just understand what the values of the family are, what the values that they hope to impart on their kids, and it's an engagement practice with the entire family. But I'll say it can be a little bit uncomfortable because it is something for some advisors. There are some that are really front-footed and they've been doing this, and for them, when they hear our message, it's like, yep, I've been doing this, and you're absolutely right. I've seen the benefit. And then there's others who may be a little slower to pick that up. Who, when we present some of the business benefits, I think they start to see it. But ultimately, it's about the end investor and how do we improve the outcome? And if you're improving the outcome for the end investor, that translates into hopefully more revenue for the advisor. Again, we want to make sure that we're being we're supporting advisors' practices, but it's always about the investor outcome. And we think that this presents a better outcome for investors. And oh, by the way, there's a benefit to you. When we talk to the head offices, they love it as well, because again, it's building robust practices that are, you're naturally going to get attrition through advisor books. And so if you have multiple generations of clients within a family, that just sort of offsets a little bit of that, that attrition, and you're building relationships when spouses pass or there's divorce. Again, you have relationships with them. You're not necessarily so worried about losing an investor because they've had a life event that, necessitates or may necessitate a move away from that lead advisor. But again, I think right now it's just telling that story and presenting them with the facts behind it and some of the data. And so, it's an awesome time to be in the markets, because that data is available, and the computing power and the people to draw insights from it are available. And so we love that. We love those stories.
I while on the last question, while I was listening to you, I was thinking, you almost want to it's sort of tantamount to establishing mini family offices for each family unit whose wealth you administer to, right? I mean, they don't necessarily have the means to establish their own family office, but the reason family offices exist is because families have taken it upon themselves to manage their own wealth professionally. And in those cases, the family and the succession is all planned out for, multi-generational wealth because of the size in those cases. But
absolutely.
But every basis of wealth in a family matters, whether it's, whether it's 5 million or 500 million or 5 billion.
Right.
If you just take if you just turn around and you take that approach to, the same way you have like outsourced CIO, you have OCIO, different outsourcing, you could almost put yourself out as outsourced family office, right? As an advisor, and say, hey, you know what? There's a lot of issues here. There's a lot of things you need to think about. I know it's not comfortable because we're talking about succession, and you may not be on the same page with every family member in your household, or in your family, and not necessarily in your household, but you may not be on the same page with your kids.
Yep.
But this is how you can get them back on the same page, is by introducing this multi-generational plan, and talking about how, your $10 million of net worth or $5 million of net worth could be turned into $30 or $50 million of net worth over the next 20, 30 years.
Absolutely. I think, whether that's the direction, who knows, but you're absolutely right. When you're thinking about the family as the unit, and you're not just dealing with one individual, it is, it does sound like a many family offices. And if you have a number of those families, you have a multi-family office practice that, has a robustness to it. And, you touched your last point in terms of having that conversation, and sometimes parents may not be on the same side and have different values than their kids, but the time to have that conversation is when everyone is at the table, and not when there's a life event that unfortunately necessitates that conversation. And having someone like the financial advisor who can mediate that conversation from a financial perspective is really, really powerful, because we've seen through some of the data that we've, that we have, when that process breaks down, and when there's failure in terms of that transfer of power, it's generally about 2/3 of the time because of communication. And it's usually communication when, emotions are very high. Again, you're talking about potentially life events. So if you do it at moments where, that stress of the life event isn't the backdrop, you can get through challenging conversations, and the advisor plays a very important role, shepherding that conversation and making sure that everyone understands the point of view from a financial perspective. What is the expectation? But then the financial advisor as well can bring in other subject matter experts into that conversation and help mitigate some of the risks. So again, when we're rolling these programs out, it's really the financial advisor sitting at the center of that conversation and saying, look, there may be a challenging situation. We have a subject matter expert that can help with this particular piece, whether it's a legal issue or a tax issue, or whether it's a charitable need, want, desire, and so that financial professional can help with that conversation, and you're having the conversation at the right time, at a time when everyone can bring their best selves to the table and have that conversation. And look, again, it is not without its challenges, but the benefits to both the family and the advisor are certainly material, and we've seen it.
Yeah. Well, I mean, Mario, it's very hard to put a value on advisors being able to leverage your company's resources. I mean, that seems to me like an incredible value alone unto itself.
We like to think so. Again, when we talk about the trillions behind us, a lot of these are from our business experience, our personal experience. So, as we like to say, it's not something that we've come up with in a library doing research. This is this is practical experience, and we're happy to share our practical experience to the benefit of the people that we help serve.
I recall Einstein's quote, make sure to make things simple, but not too simple.
I
right?
love that quote.
And
I love that quote. Investing is simple, not easy. Yeah. I agree. I agree.
Mario, wow. I mean, it's been a real pleasure to chat with you today. I want to, thank you for your incredibly valuable time and insight. I hope you'll come back so we can continue this conversation.
I appreciate the time, Pierre. Anytime you want me back, I'm happy to come. This has been a lot of fun. So
awesome.
Thank you.
Likewise.
Thank you again.